What's going on, guys? Welcome back to another pre-market warm-up. I call it the pre-market warm-up. I still need to think of a name for this show. That was the one I went with for the first one. Second one, I just called it the daily market update. Pretty boring, so I'm going back to the warm-up here. If you have any suggestions for a name for the show, please throw them in the comments below. But I need a new intro. I haven't figured one out yet for the show. But we're going to walk through the setup, another busy day. Same type of setup that we had yesterday, but now we're getting to the point where it is time, in my opinion, to start positioning for this next leg down, and that's exactly what I did. So I'll show you what I did yesterday, walk through the setup that I see today, and then give you some things to take with you and hopefully implement right after the show. So let's just jump in. Let's take a look at our premium section. This is where I send in all of my alerts throughout the day, so just to show you exactly what I was doing. So in the morning, I started off shorting some high yield. HYG is the ticker on that. I had another big overbought signal in high yield. I was actually buying shorter term puts for this. I generally don't trade options, but I saw a pretty good opportunity. They also had an implied volatility discount, meaning that the options were fairly cheap relative to 30-day realized vol. So they had a 30% discount implied vol to realized vol. So that was a good spot, in my opinion, to start leveraging up those bets on the short side. I was also adding to my short Russell position. So a long ETF is TZA. You could just short the Russell straight up, but a lot of people like to just rather buy a long ETF, the inverse there. So that's what I started buying. Got pretty big up in that throughout the day. So I'm still betting on the short side of the Russell 2000 small caps. And I also was taking down long exposure that I had in China just because the US was pressing the top end of the vol ranges there. And then into the close, I was buying some TEX, which is a short tech ETF. So I mentioned in the show how I wanted to get back to the short side of tech. I had a big overbought signal in XLK. So to get some leverage on that bet, I went with the inverse ETF of TEX. But I'm still not seeing anything that would suggest anything other than a bear market rally. So I'm going to walk through a couple things that I was seeing yesterday. Other than, I guess we could just take a quick look at the US equities dashboard. So no changes to any of our trend signals. Pretty much everything has flipped to positive price momentum. But like I said, that doesn't change anything in terms of the longer term trend. Still plenty of overbought signals out there, all coming on lower volume. Yesterday, we also walked through how the net short positioning in the S&P and the Russell specifically were fueling this move higher. So I want to give you a couple more visuals of what this kind of looks like and show you the flows here in the market. So here's just a quick chart from the dark pool. So if you look at this yellow line, this is the dark pool flows that have clearly not bought into this rally. You can see the S&P is the purple line here. So like I said, we're not really seeing any big flows come into the buy side. It's mostly just driven by these smaller cap short squeezes. If you take a look at this chart, you'll see that the highest performing basket of ETFs yesterday was the short basket, the high short interest stocks. This is from Goldman for the prime brokerage data, and that is what is helping drive this move higher. So we're not seeing any significant flows come back into the market. We're seeing all of these short squeezes and we're seeing these pumps higher on low volume, and that's not something that you want to be chasing. And this was also brought to my attention yesterday. Apparently, I don't use this indicator at all because it absolutely just doesn't work. It doesn't really mean anything. The average of the price doesn't make a difference. It doesn't actually give you anything actionable to take a position. But I was looking the 50-day moving average here, looking at the Qs and on the SPY. Apparently that broke 2 days ago. So this clearly sucked a lot of people in, but that's not what I use. I'm using my trend signal here. Still remains bearish trend and as well as these ranges. So we're right up towards the top end of the volatility range here. Bad spot to be chasing. Like I said, this is a great opportunity to start positioning for the next leg down, in my opinion. But that's just what I did. So that's what I did. That's currently what I still see in the market, but there is one more thing that I want to point out. This is extremely important to note. You've probably seen this plenty of times on my Instagram, but I want to walk through this dealer gamma chart here. So if you look and you'll see this, there's two sides to this. So you have the red and then the blue over on the right. And the green line represents where QQQ is right now, and the red line is that gamma flip. What this chart shows you is dealer gamma for the NASDAQ. So when we're on the left side of this chart, which we currently are right now, you can see that massive slope down towards 260s. And if we scroll up a little bit here, you'll be able to see this is for the S&P. This shows you actually call and put gamma by strike. So the blue represents calls, and then you have in the red are the puts. So what this shows is that based on where we are, the dealers aren't necessarily looking to take, or they're not looking to take a directional bet at all. So they don't care if the market goes up or down. They're just there to provide liquidity. So that's where these models come into play. And you have to pay attention to where we are, given the exposure on both the call and put side. So when you have a large demand for puts, and we're in that negative gamma regime, you can expect volatility to be heightened. You can also expect that as we start to move down, dealers who don't want to take a directional bet, they're going to have to hedge that exposure. And the way that they do that, you probably heard the term delta hedging or gamma hedging. And essentially what that means is that as the market drifts deeper into negative gamma territory, dealers are going to have to hedge on the way down. And the way that they hedge is by selling. So they're going to have to be selling on the way down, which is going to perpetuate that move. So this slope kind of gives you an idea of how fast, how deep it can go. You can see it gets pretty deep down towards 260. So if we start to continue to break down and we don't flip into positive gamma territory, once we're in positive, that's when the dealers would actually work in your favor. They'd be buying on the way up because they have to hedge those positions up there. And you'll notice that these two are right next to each other right now. So this is a key inflection point. If we fail, or if we do cross over, it'll be even more bullish for the market. But if we fail here, which is likely because we're towards the top end of the volatility ranges and we still are in that negative gamma regime, then the probability of us moving down in towards negative gamma territory continues to rise. And that's when you get those quick, aggressive just liquidations to the downside, because you have everyone selling, and then dealers on top of that are even perpetuating that move lower because they have to delta hedge on the way down. So that's kind of just a quick update there. It's the same for the S&P. If you look at the S&P, we have a major level right at that 4,000 strike. So that's on the calls. So if you're looking just on where this market could or should top out, you would assume that it would probably press up towards that 4,000 level if it does get up there. Not saying it will. I personally don't think it will. But it could, just based on positioning. There's a lot of open interest at that 4,000 strike. So once we get up towards that 4,000 level, that's when you'll likely start to see an immediate term resistance. Those large gamma levels generally act as support or resistance. But the S&P definitely has a lot of chop to get through to get up towards that 4,000 level. But I do think that the NASDAQ is more important to pay attention to, just given where it is relative to zero gamma. So zero gamma is that red line. If we do cross over, that's when the dealers will be working in your favor. They'll be buying on the way up, so that'll increase the sell pressure. But if we fail here, and it looks like the NASDAQ is flat to down, so it's still teetering right on that level. But if we start to shift lower, you can see the slope of this curve, and as we move down, drift lower into 290, 280, it gets pretty deep down towards 260. So even though 260 might seem like an insane move from where we are right now, that's definitely still on the table if we do fail here and we start to shift down lower. So that's all I have for you today. I wanted to keep this one quick and get it out there for you. But if you have any questions, throw them down in the comments below. Today's going to be a big day, so we're going to have to see how the market closes here. Tomorrow we'll have some more updates just based on what happens in today's session. But if you like these videos, hit that thumbs up for me, subscribe to the channel, and I'll catch you guys back here tomorrow. Peace.